Thank you very much for joining us at the External Reporting Board today. Ko Amelia Sharman toku ingoa. I am Director Climate Standards here at the XRB, and we're really delighted to have you with us here to talk about our strategy disclosures that we are currently consulting on. So today's session is looking at the specifics of the strategy disclosures for the financial sector entities that are caught as part of the regime. So as you probably all know from the presentation we gave as part of the launch, these are our large financial institutions, our banks, managers of investment schemes, credit unions, insurers, Crown financial institutions, etc. So today, what are we going to cover? Firstly, just a tiny little bit of context, just for those of you who would like a tiny bit more information about what we're doing, but then we really want to get straight into the proposals on the strategy disclosures. We'll be covering the strategy disclosures A through D, including the first-time adoption provisions. We'll be looking at the key concepts, some example disclosures specifically relating to financial sector organisations, and we're having Q&A as we go at regular intervals throughout the session. So please put your questions in the Q&A box or the chat box, whatever you find easiest, and we will get through those. And today we're also really pleased to include as part of the presentation Ronan McCabe, who is Chief Investment Officer at Mercer, New Zealand. Ronan joined Mercer in 2019, and before that taught finance at Trinity College in Dublin, Ireland, and worked as an investment manager with Ireland's National Treasury Management Agency. That is actually the Irish Sovereign Wealth Fund, which is valued at approximately New Zealand $25 billion. So Ronan will be sharing his insights and experience relating to Mercer's voluntary TCFD disclosures later on in the presentation. So, just a reminder, we have at the XRB, we have been consulting on the 4 thematic areas of our proposed standard, NZCS1. We consulted on governance and risk management in October last year. There's a feedback document on our website on those 2. And we're currently consulting on strategy and metrics and targets. And today's presentation is looking in detail at the strategy disclosures. Really keen for your questions. Please do ask them as we go, and we will look forward to answering them. So over to Jack.
Thanks, Amelia. Kia ora koutou. So I'm going to take you through our proposed strategy disclosures today. Really looking forward to the session, and again, thanks to Ronan for joining us, and we'll kick over to Ronan about partway through working through the strategy section. So the first thing I'd say is that this is a deep dive today on really our proposals in the consultation document. Really keen to give you more exposure around what exactly have we proposed and where are we seeking feedback and what was some of the thinking in behind those proposals. So before I kick off on strategy, one thing that we emphasized at the launch is that, you know, this is about your strategy and what your entity is trying to achieve. This is not about having a separate climate change strategy necessarily. It's about how climate change will affect your strategy and what you're doing in response to that. So firstly, what have we drawn on in putting this strategy section together? I mean, largely we've started with the TCFD, certainly the recommendations and the implementation guidance, as well as those additional supporting materials. And we're also having very strong regard for what's happening globally now with a lot in play. We have the Technical Readiness Working Group's climate disclosures prototype on the right-hand side there. Also other important developments by other standard setters, including EFRAG, the T5, and then many of you will have seen just last week, new proposed rules out from the US Securities and Exchange Commission, which are all moving at pace. So let's get straight into it. So this is effectively an overview of the proposed section that we have on strategy. And we have the objective, which is important, that sits over the top. And then we have effectively 4 high-level disclosures that then get broken down into further sub-disclosures that we'll get into step by step. But largely, I'll be referring to these as strategy A, B, C, and D. And A, B, and C effectively align with the TCFD's recommendations, A, B, and C, and we've added this fourth, methodologies and assumptions relating to scenario analysis, which we'll explain in more detail later on. So this section we definitely acknowledge is clearly the broadest in terms of the whole standard, in terms of how much ground entities will need to cover. And we've proposed first-time adoption provisions to reflect this, to allow lead-in time on some of the disclosures. So we'll also work through where those first-time adoption provisions come in as we go through. So this is the objective, which we would say has an important role in reading each of the individual disclosures beneath it, because this is the test for preparers to be coming back to in terms of whether or not they're meeting the overall objective. And it's broad. You know, this is covering a lot of territory in terms of how climate change is impacting on the organization's business model, strategy and financial planning, includes the financial impacts as well, and then it also includes how an entity has made use of scenario analysis as well. So we'd definitely say it's a broad objective to be thinking about meeting in this area. And underneath that, our first main disclosure is strategy disclosure A. So that's effectively asking for a description of the climate related risks and opportunities. And that includes this reference to the short, medium and long term. And then below with these sub disclosures, we also have the additional disclosures around these time horizons. An important decision we've made in this area is not to be looking to be prescriptive on time horizons. We think it's, you know, there's a lot of existing TCFD guidance out there already around types of considerations to have regard for when making decisions about what time horizons are appropriate. And we think that's more meaningful for primary users if entities do that work themselves, rather than having sort of set timelines that are set in stone for people to work to, even if there's some benefit there for comparability potentially. So those are the key sub disclosures there. And next slide I'll get into is effectively the proposed first time adoption provision that's relevant here. And the reason that it comes in strategy A is the mention of financial impacts starting to come through already. And so the reason that we've done that is because we, we think it's important that when it comes to disclosure of information related to financial impacts, that entities really spend the time to make sure that they're doing that to a high degree of quality, and that there's not, in the early days of the regime, a sort of race to get to some potentially misleading numbers just to satisfy the regime. You know, we think it is difficult to do some of this analysis around financial impacts, and so we want to allow lead-in time. So the first time adoption provision we're suggesting is that no information would need to be required in the first climate statement in this case. And effectively across the board, when we get into financial impacts in more detail, really what we're looking at is enabling entities to start more qualitative early on, and then the expectation rise over time to bring in further quantification. So this slide is covering climate related risks and opportunities at a very high level. So effectively, this is the whole gambit, if you will, in a way. So this is the transition risks and opportunities and physical risks and opportunities down the bottom. And this is the standard categorization of the TCFD, and we would expect this information to be appearing underneath strategy A. And sometimes people think that information is going to show up over in the risk management section, but it's actually important to realize that it comes up and under strategy A in terms of what are these, and disclosed and analyzed in a way that's specific to the entity rather than at this high level that you can see here. So here's an example, first example for the day, which is from Schroders, who's a large asset manager. And this is their disclosure under a voluntary regime in terms of their climate related risks and opportunities. Just a quick caveat that, we're showing these examples just to help communicate the type of information that we would generally expect to see in this area. But obviously these voluntary reports have been done without having any regard for our proposed standard, given that it's still in development. But this gives you a sense. So obviously they've laid it out there with risks up the top half and opportunities on the bottom half, and then a sort of a clear labeling of the risk in question, a description of it, time frame, again, that link to the short, medium and long-term language, and then the impact there as well. And on the right-hand side, there's also some more granular information provided about how they're thinking about risks and opportunities, more specific to the particular funds in question that they have, and obviously noting there in that second paragraph that they have a range of tools they've developed to help them manage their climate risks in that at that level. But on the left-hand side, a lot of this information can be considered to be quite broad and covering a lot of territory in terms of a broad range of risks and opportunities. So that's us for strategy A. Now we'll pause for questions.
Jack, could you just repeat the last bit, your last couple of sentences?
On the last slide, sure. What did I say? That's a good question. I think I was just saying that, clearly I think looking at this risk and opportunities table from Schroders just indicates how broad that entities are looking when it comes to risk and opportunities and the different ways that they're going to impact them over time.
Brilliant, thank you. So question time. We've got just one very easy question to answer. Will these slides be available online later? Yes, the slides will be online later. The slides for all our deep dives will be online, as will a recording of them all. So next question. So just to be clear, no financial information needs to be disclosed in year one.
Maybe we'll come back to that a little bit later. I'll get into more detail about all of the first-time adoption provisions for financial impacts, and financial impacts comes up, a little bit of reference in strategy A, and then quite a bit in strategy B. So we'll cover that next.
And then just to be clear, that when any entity decides to use a first-time adoption provision, they must disclose that they have used it. So you don't have to use a first-time adoption provision, but if you do, it should be disclosed that you have used it. And yeah, as Jack said, we'll get into some of the details of the other ones. So next question. For businesses made up of multiple entities, is it okay to report at the parent organisation level covering all parts of the business, or do we need to provide a separate disclosure for each entity? So the answer to that is in the legislation. So the legislation specifies the reporting is at entity level, FMC reporting entity. There are specific sections in the legislation that talk about group reporting if you have subsidiaries. So we will provide information around group disclosures, but yeah, please have a look at the legislation. If there are any uncertainties around whether an entity is a climate reporting entity, how it works in terms of your subsidiaries, joint ventures, etc., we recommend getting independent legal advice. And then if there is still uncertainty after that, we recommend speaking with the FMA. So next question is, do you believe that there are any examples of reporting globally which would meet the New Zealand standard?
Good question. I think, under a voluntary TCFD regime, I think it's fair to say that entities have a touch more flexibility in terms of being able to do, say, a substantial job on risk management and then only covering parts of strategy. So I think that is a evolution in this area, is that with standards coming through, not just in New Zealand but around the world, that's trying to raise everything up to some degree of a floor. So I think that I'd be certainly having regard for that, but otherwise, there are no shortage of good global examples to be looking at and drawing from. And yeah, I'd certainly, we're designing this in a way very much based on existing practice.
And so it's a kind of very similar question is, to confirm, the Schroders example would be acceptable under the first-time adoption provision?
I think we would not be putting this up as a here's the way to meet the standard. We're putting this example up as a way to effectively talk about the concepts of risk and opportunity in general. I would say that what we'll get into in a minute on financial impacts, what I showed on the Schroeder slide, they had a bit of information there that was actually called impact, things like decreased revenue. I'll get into that in a little bit more in terms of how we're thinking about this idea of more qualitative information on financial impacts, leading into more quantitative over time. But don't want to suggest that anyone goes and tries to copy and paste anything. We think the whole point of this regime is to think about how climate-related risks and opportunities will impact you, and then to disclose after you've done that work.
And then a supporting question is, could we circulate a list of best practice examples? So I can answer this. So we are not going to provide templates for disclosures. We are not going to circulate best practice examples because we don't know what they are yet. We haven't seen disclosures under this regime. Over time, we might, as we see climate statements come out, there might be the ability to do this, but we're really, really clear that the disclosures under this regime as a mandatory regime are are going to be different from what voluntary TCFD disclosures have looked like. So we will over time be really interested in what people will disclose, but no, we're not going to be providing templates or best practice at this stage. And then one other question, if you have been disclosing voluntarily before financial year 24, can you still use the first time provisions? Yes, absolutely. The first time adoption provisions relate to NZCS1 as a mandatory standard. They relate to you the first time you disclose. If you become large and then enter into the regime and use them, you can use them. If you then become small and then become large again, you can't use them again. So they're for the first time that you disclose. One more question I think that we can answer as we go now is, the strategy section proposed to disclose business model, strategy, and financial planning. Is it covered in your example? How should the business model be described?
Thanks. Yeah, it's a good question. So I don't believe Schroeder's used the word business model. You can, I think that they were using business. So business and business model are probably the two standard terms in this area that mean roughly the same thing. So TCFD very much was using the term businesses a lot more. And now the reason that we've decided to propose that we'll go with business model is because that's the way we think that the other standard setters are likely to go as well. And the very high level way to think about it is, strategy, what are you trying to do? Business model, how are you trying to do it? And we may need to do more guidance in that area specific to what we're expecting on business model. But really the definition you can have a look at is in the defined terms, drawing on pretty standard use of the term. I'd summarize it very coarsely as saying, how you're trying to do and what you're trying to do.
And then one last one to finish this off. Is there not a concern about comparability without prescribed timeframes? The answer to that really is we are trying to do this at a very high level, a flexible and principles-based standard. We confirm everything down to the last detail, but at this stage we don't want to do that because we don't want to say what might be most meaningful for you. Over time, if we can see that there is, that is causing a big difficulty in the reporting, we might move to be more prescriptive in certain areas than we are at the moment. But obviously, we also think the market will influence some of this. If someone is talking about long-term, being 3 years, and that's actually not meaningful in your context, we think that that's going to be pretty clearly obvious. All right, so we might just thank you for the questions that are coming in. We're just going to keep moving and we'll try and get to everyone's questions. If we don't answer your question in the session today, we haven't got a record of them all and we will be answering them either directly with you or on our website.
Thanks, Amelia. I will keep moving. The one thing I'd add on the time horizons, which I think is a good question, is that what we'll touch on later with scenario analysis, we're hoping we'll go some way towards some common approaches to time horizons within sectors in a way that does make sense. So we'll get into that in a little bit more detail soon. Okay, so the next section that we're going to cover is strategy disclosure B, and this is now moving from the risks and opportunities to their impacts on the particular entity in question across their business model, strategy, and financial planning. And the sub-disclosures we have there include, and again, this is where there's quite a lot of information in these sub-disclosures for B, description of the business model and strategy, actual impacts, actual financial impacts, and the others you can see there. I would draw attention to the fact that that first disclosure is one that we've added, and we are looking for feedback on that one in particular. So we are the reason we've done that is because we're looking to ensure that, well, when any entity is describing how climate change is going to impact on their business model and strategy, that primary users have got a good, easy to access understanding of what that actually looks like in terms of the entity's business model and strategy. But we're not expecting there to be the secret sauce being thrown out on the table. Therefore, we're expecting those disclosures to be a short narrative description of what the business model and strategy are, but emphasis on short and punchy for primary users rather than anything detailed. Obviously, on the bottom of this list as well, we're proposing disclosures around transition and adaptation plans, which we think are important, and we'll get into those next. So these are the relevant first-time adoption provisions that we're consulting on in this area. So we have got relevant to the actual financial impacts, some first-time adoption provisions, and then we have slightly different provisions for transition plans. So on the actual financial impacts, and this is the same as what we're saying on what we'll get into next, which is potential financial impacts. We're saying that in the first climate statement, the expectation would be that there is disclosure of qualitative information, and then from the second climate statement onwards would be quantitative information. So that Schroeder's example, for they had words like decreasing revenues, that sort of level of granularity, and then the example we showed yesterday with the corporates, for example, with Meridian, they'd turn that into a dollar figure in terms of effectively what they thought that could look like. I mean, generally speaking, in this area, we'd expect a lot of entities to be using ranges. Is pretty common practice at the moment as well, given that we are talking about quite a lot of uncertainty in some of these numbers. Transition plans, we've effectively proposed there that in the first climate statement, the requirement will be to disclose progress towards developing a transition plan, and then from the second climate statement onwards, disclosure of the transition plan aspects of the overall strategy. And the reason that we're doing that, we understand that transition plans are increasingly demanded by primary users. Not all reporting entities are there at the moment in terms of having one. So there's a lot of momentum in that space in terms of work going in. And so we're trying to strike that balance. On adaptation plans, we've also proposed first-time adoption provisions. So for the first two climate statements, the requirement would be simply to disclose progress towards developing an adaptation plan. And then from the third climate statement onwards, that would shift to disclosing the adaptation plan aspects of the overall strategy. And the reason that we've given more lead-in time on adaptation plans is because there's less urgency around those compared to transition plans in the context of the Paris Agreement and 2030 emissions reduction objectives. And we also think it's important that entities build more capability and capacity in this area and thinking about how they can take adaptive action. And it's a good idea that that comes after doing things like scenario analysis. So a quick slide here on the difference between impacts and financial impacts. We tried to make this a clear distinction in the standard, and we've also tried to ensure that these words actual and potential are well understood. So I'd definitely have a look at those if you haven't caught up with some of those terms, but effectively impacts being the higher level effects of climate related risks and opportunities materializing on the entity, and then financial impacts is where you start to move that into a more granular level and translate impacts into actual or potential impacts on financial position, performance and cash flows. And we are using this word, and this is consistent with the TCFD, actual being impacts that have already occurred, in the previous or current period, and then potential being the forward-looking impacts. So I encourage you to have a look at the questions that we have in the consultation around these terms, which are important. So transition adaptation plans appears in this part of the standard. So what are they, first of all? So a transition plan is the aspect of an entity's strategy and their overall business strategy that lays out a set of targets and actions supporting its transition towards a low emissions economy. So it can include things such as reducing emissions, but also going beyond that to things like the development of new financial products and services. An adaptation plan on the right-hand side, that's the aspect of an entity's overall strategy that lays out how it aims to minimize risks and capture opportunities associated with the physical climate changes. And, you know, what we're really drawing on heavily here is the TCFD's most recently updated guidance last year in October 2021, where they more explicitly address this disclosure of transition and adaptation plans in response to a lot of surveying and work they did, where primary users are effectively saying they increasingly see them as core parts of an organization's overall business strategy. As I said earlier at the start, you know, this is not about having separate disconnected plans, but the drive is really for ensuring that these are thought about as part of the overall strategy. And the TCFD conducted a survey which asked primary users whether they thought this information was useful, and 96% of users responded that organizations' disclosure of transition plans would be very useful or somewhat useful. And so we are requiring the disclosure of transition adaptation plans and seeking feedback on that at the moment. So I will now kick over to Ronan from Mercer. Thanks again, Ronan, for joining us to talk to the work that Mercer has done in this area.
Right, thanks, Jack, and good afternoon, everyone. Just maybe a few minutes on Mercer, what we're doing in this space. So Mercer New Zealand has committed to net zero by 2050 with an interim target of a 45% reduction in carbon intensity across its portfolios by 2030. And under the TCF pillar of strategy, which I'm going to spend the next couple of minutes talking about, this idea of transition and adaptation is a key part of how we're looking to manage client portfolios. What we do is we manage obviously, a number of different portfolios, a huge amount of portfolios across New Zealand and also globally. We're a manager of managers. We build portfolios with underlying sub-advisors. Through the guises of climate modeling to start off with, before we get into transition. So Mercer has been developing its own climate scenario modeling for nearly 10 years. And this has been documented in a number of public documents in 2015, Investing in Time of Climate Change, and then again in 2019 in the sequel. And our climate scenario modeling, it takes very much a forward-looking approach. So it complements the traditional backward-looking or historical approach that you have in building strategic asset allocations. And the key benefit of this is ability to prioritize forward-looking climate-related risks, as well as opportunities and the potential to think about them under different scenarios, how that works on portfolios and asset allocations, and how we think about transition. What we've done is, in addition to our own scenario models, we've built a tool called Analytics for Climate Transition, or ACT, and we run all our portfolios through this tool. And I'm going to spend the next few minutes talking about the concept of that and how then we kind of get out from a portfolio perspective and then next steps. And our ACT tool, Analytics for Climate Transition tool, draws on multiple third-party metrics at the company level emissions. It looks at transition capacity as well as green revenues, and then breaks it down into a series or a portfolio into a spectrum from dark gray, which are effectively high carbon and low transition investments, to more green, those with low carbon or more kind of climate aware transitions. So on this particular slide, it's effectively a four-step process where we think about the commitments to net zero and the transition pathway, where we calculate a baseline, and this was set as June 2020 in our portfolios. We then, running through our ACT tool and a series of scenario analysis, as well as stress testing, we analyze a number of different portfolio possibilities. We then set measurable goals, net zero by 2050, but also more importantly, that target of 45% reduction by 2030. And that's really important because in order to hit net zero by 2050, we think a lot of heavy lifting has to be done in the next 8 to 9 years. And then finally, how we implement the plan, and the implementation of the plan and the implementation of the strategy, we'll talk about briefly. But on this slide, again, just underneath, we've given you a hypothetical example of how we think about transition. And what's really important about this is a hypothetical equity portfolio of underlying companies. What's interesting is those dark grays in the far left, in the weight, these are companies that have high carbon intensity and have a very, very low probability of being able to transition to a lower carbon world. There might be kind of fossil fuel companies, for example, or certain utility companies that won't be able to transition to more renewable energies. And as you can see, while their weight in the portfolio is less than 1%, their carbon intensity is nearly 1/4. So what we want to do is, through this proprietary analysis, we want to be able to kind of see how that portfolio, where we need to be kind of be working with our underlying companies to actually, the value add of having those companies at a low weight in the portfolio and how that feeds into from a carbon perspective. What we're really looking to kind of work on is those yellows and the in-betweens, having more and more of them. And they're sort of companies that are, have varying carbon intensities and transition prospects. The way we like to think about it is, if you have two companies, company A and company B, as of a point in time today, company A could have a higher carbon footprint than company B, but has a much stronger trajectory or pathway to and transition to a lower carbon world. And that means that while company A might have a higher carbon footprint or carbon intensity today, you want to kind of hold it in your portfolio because it will help you get towards that transition to a lower carbon world than company B. Moving on to the next slide. And what we're seeing here is, again, this is very simply, again, putting this all together from a SAA. So for example, for a KiwiSaver fund or a super fund, and again, this is a hypothetical example. We look at asset allocations on the left, and in particular, in the purple there, there's the small purple slice at the bottom. It's called listed infrastructure. And while there's a small weight in your portfolio, on the right-hand side, you can see it's quite a large, it's 1/4 of the carbon intensity in the portfolio. And that's something that we know as listed infrastructure as an asset class. Over 40% of that index or universe is oil and gas pipelines and utilities that are kind of quite poor, or quite those dark gray companies. The question what this does is, from a TCFD framework, and what we're trying to kind of disclose is, it's very much part of how we build portfolios in terms of the strategy, the ongoing risk management. And it raises questions: why do we have an asset class like this in a portfolio? From a carbon intensity perspective, is it really given that much from a risk and return perspective? We don't generally like exclusions. So we do believe working with managers and working with companies as part of that transition. And I'll go on to that maybe onto the next slide. So bringing it together, how we think about, once we've kind of implemented a strategy, it's true of kind of 4 key pillars. And these 4 key pillars, while we're talking today about TCFD in the context of the New Zealand CRD framework, the idea of integration, active ownership, investing in sustainable solutions, and screening, they very much align with how we think about sustainable investing, or ESG in general. And integration, I've touched upon how we think about building strategy into a portfolio alongside the TSD framework, but we also believe we are very much an active owner. So this means very climate-focused conversations with our managers. We track all our manager engagements. Where we can, we've got our managers to effectively legally acknowledge and legally commit alongside us in portfolios they manage, again, within a fiduciary responsibility. But we also are actively vote and engage with underlying companies where we've material holdings on climate voting at AGMs and EGMs. And we're also part of a series of global initiatives right around the world. Some of them mentioned here, collaborative initiatives, the idea of actually bringing weight of capital that we have both in New Zealand and globally alongside similar asset owners around the world in addressing this. Thirdly, we believe in investment solutions. So it's not just about doing the analysis and engaging with underlying companies. we're proactive from strategy perspective of how we think about investing into the portfolios. So this means increasing allocations into lower carbon, more sustainable themed exposures through SAAs, which we believe that, you know, we're not giving up anything from advantage to return. If anything, we think it's better from a risk perspective. For the best part of the decade, you know, we've been public and we believe that climate change is a systemic risk. Investment management is a process of managing risks in an investment lens, and these sort of investments, lower carbon, sustainable themed investments, are very much about improving returns, we believe, in the long term for clients. And finally, screening. So we do kind of very much aware of those higher carbon intensity exposures or companies that have low probability or low transition capacity. And, you know, we challenge our managers the role, why do you have them in the portfolio? You know, when you acknowledge that climate change is a systemic risk, some of these assets are potentially stranded assets. So if they are a small portion of the portfolio you manage on our behalf, what's really the rationale? Do they really add that much to the return expectations of the portfolio, given that they have quite a large carbon intensity in the portfolio? Putting this all together, we've recently published our first climate change management statement. That's a public document, and a lot of these materials are taken from it here. But that was written very much in line with the TCFD framework. So again, while I'm speaking about strategy, we also, that document covers along governance, risk management, as well as metrics and targets. Jack, I might pass back to you or maybe if anyone kind of wants to ask questions.
Brilliant. Thank you for all those insights, Ronan. It's super interesting. We've got lots of questions that have come through, and I'm just going to group, there's a selection of questions which are asking a lot about the technical calculations. So how you calculate, Ronan, a proportion of the carbon intensity? How do you draw the line between those darks and light greys? Are they scope 1, 2, and 3 emissions? Are they just scope 1 and 2? How do you deal with missing emissions values? So basically a general question on the assumptions and methods that are underlying all of this analysis, and then how much of that is disclosed in that plan that you mentioned.
So obviously there's actually quite a lot there. So it's actually quite a technical model and it's proprietary. So we don't disclose the methodology of the model itself, but we do disclose, so some of the data providers and, our MSCI, their ESG research, as well as ISS. We do, one of the challenges, and it's fair to call out, in the general universe of ESG data providers, there's different data providers have different ways, and sometimes you can have different results for the same company. So where that's the case, we might kind of average across different data providers. We also look at, we've a number of different data providers looking at a number of different factors. How we look at, so an individual company will have a scoring system attached to it, and it'll either be a dark gray, light gray, in between, whatever it may be, and that's the result of a portfolio. So hypothetically, say we have a portfolio of 100, an equity portfolio of 100 underlying companies, you might have a case that 1%, so one company has a real dark gray, but it contributes maybe 25% of the carbon intensity. The question, so that's just an output from the model. In terms of the kind of coverage, it is fair to say equity markets are or equity companies are much more further advanced as an asset class in terms of its disclosures and the data you can get on that than what you'd see maybe in other asset classes. Credit as a sub-fixed income asset class is getting better at that, but at the sovereign level within fixed income or within the bond space, that's less so, and private markets have more of an issue. So we track, when we do analysis, what the coverage is within a given portfolio. So if it's equity, it might be 99% of the underlying companies we have data that we're comfortable on, while if it's fixed income, it might be 70. If it's a private property portfolio, it might be lower. So we base that kind of conviction into our analysis as well. So when we get, this is not an exact science. What we're trying to do with all this, as you do with any modeling, is it's a guide to what we think, an uncertain future is. And we're trying to use it, and we hit it from different lenses. We also overlay a lot of scenario analysis and stress testing around that. So sort of stress testing or sort of scenario analysis we do is we look at scenarios at 1.5, 2, 3, and 4 degrees Celsius warming. by 2030, 2050, even 2100. A stress test is an extreme event where at a 2 and a 4 degree warming, where the warming scenario suddenly jumps to 2 degrees or suddenly jumps to 4 degrees, and 80% of the market build that into expectations, which effectively probably means a market sell-off. And how does that do in your portfolio? So that's quite an extreme stress test. But the big thing in terms of the technical side of things underneath, it's different data providers. We look at many different factors. Where we've arrived at is probably over 10 years of different sort of scenario analysis. Coming back to some of those public papers we've arrived at over the last 10 years, and we've got to this point in time. So I don't know if that answers the question, but it maybe in terms of disclosures, we don't disclose in detail the underlying methodology in detail, but we do kind of at a high level.
Brilliant, thanks, Ronan. And we will be talking a bit more about the methodologies and assumptions in our proposed standard later on in the presentation. So we've got lots of questions. We won't be able to get to all of them today, but I'll just take a couple more. Can we assume, this is for you, Jack, can we assume that when you state in this presentation that you are looking for short, sharp narratives, that this will flow through to the guidance the XRB will be issuing? Seeing this formally in writing will give comfort to climate reporting entities.
Thanks. Yeah, that's a good question. You know, conscious that we are developing a standard, we also have plans around guidance as well that are live at the moment. There, I believe, is reference in the consultation document to that aspect of the disclosures at least being brief. So, you know, that's at least in writing at the moment.
And then I think one more we can take now before we move on, which is in terms of action and potential financial impacts, what about scenarios where we know our business can take actions to avoid financial impacts? Do we still need to disclose what would happen if we didn't take those actions?
Yeah, very good question. I think there is, part of the purpose of this area is to be getting some transparency around, you know, high level directions of change. Obviously, if there are mitigating factors that you think are relevant, then it's likely you'll be able to disclose that and qualify other numbers. But, you know, to some degree, things like a runaway hothouse world climate change scenario, there's little you can do as one individual entity to change those outcomes. So some of these outcomes that we're actually talking about in the scenarios are global in nature through to national level, which have important implications to be thinking through. And I think that the overall focus from our point of view on the strategy section is to focus then on what changes to the strategy, business model strategy and financial planning may be necessary to best manage, you know, so that you don't, the focus is not just tell us how poorly you look in these different worlds or how well you look, it's tell us what you're doing in response. And, you know, similar to how Ronan's laid out, there's plenty of space to cover in terms of changes you can make to set yourself up as best you can.
Brilliant, thank you. Oh, sorry, Ronan, you go.
Yeah, I think just following, I think that's an important point that Jack raises, that, you know, it's not a case of just doing the scenario analysis, the modeling. We're very aware that it's the steps you take beyond that. So when we do the modeling, the scenario, you know, we look at it, and again, that example where 1% of your portfolio could have those dark grays, as we call them, which are high carbon intensity, low transition capacity. So that might be 25% of your carbon intensity at the portfolio level. What are you going to do about them? So we disclose that, but it's a case then of we need to be proactive around that, because it's, you know, disclosing is one thing, but as part of strategy overarching under the TCFD framework, we're trying to kind of put also, you know, talk about how we actually take that analysis, that modeling, those scenarios, and how we're looking to kind of implement change in the portfolio. And where that kind of feeds into is the implementation side of things. So, you know, we're talking to underlying managers, challenging them on why they hold company X in the portfolio, given that it has a high risk of being a stranded asset. You know, how are they addressing climate change more broadly? So I think it's important is as part of the disclosure of how you actually, from our experience, think about beyond and be proactive about, you know, implementing changes or suggesting changes as part of wider strategy.
Brilliant, thank you, Ronan. All right, we'll move on to disclosure C.
Thanks, Amelia. Okay, we're getting maybe a touch behind time, so I'll speed up, hopefully just a wee bit. So strategy disclosure C. So this is looking at now the resilience of the business model and strategy to different climate-related scenarios. And in here, this is where we get into potential impacts, as we just laid out just then, how the business model and strategy may change to address those potential financial impacts, and then a description of scenario analysis undertaken. And importantly, we're proposing at the moment that entities will be using at least a 1.5 and a greater than 2 degrees scenario, and we consider that to be in line with where other global standard setters are going in this area, and effectively in line with the TCFD's original intent as well. So again, on the financial impact mentioned, we have the same adoption provisions that we've shown up already, so I won't read those out again. But again, that idea that we would be expecting it to look qualitative early on in the first climate statement, and then adding the quantitative information over time and getting more specific. So that's strategy C in terms of the disclosures. And now I'll kick over to Stef to run you through a bit more around how we're thinking about scenario analysis under that.
Thanks, Jack. Scenario analysis typically means different things to different people, so I think it's worth making clear what we mean by scenario analysis in the climate-related disclosure world right from the get-go. And in that context, scenario analysis is a process for systematically exploring the effects of a range of plausible future events under conditions of uncertainty. So its key purpose is to test the resilience of an entity's business model and strategy. And in the process of doing that, climate-related risks and opportunities are typically identified as well, which is useful because it feeds into some of the wider disclosure processes that go on. The proposed strategy section of NZCS1 requires entities to describe details of the scenario analysis that they've undertaken. As we've sort of touched on before, that's not often always the case, but we think it's really important that it is done here. And we would encourage you to look at our proposed definitions in doing that. The term scenario analysis and climate-related scenarios are very important when you come to disclose that information. So have a look for that. Look out for the 2-page fact sheet that explains that a bit further as well. They're all on our website. Now, the key decision that we've made on scenario analysis is that we've proposed to align with the TCFD and the TRWG by requiring that disclosure is made in relation to, at a minimum, a 1.5 degree scenario and also a greater than 2 degree scenario. And the XRB has spent the last few months sort of engaging with sectors to encourage entities to start on scenario analysis at that sort of sectoral level, because many sectors are doing that already, which is fantastic to see. So there's a lot of collaborative projects that are already kicking off, and we encourage you to stay across those kind of developments and see what's happening in your sector. And the reason that we've encouraged that sectoral collaboration is because the translation of the higher level information about global patterns of change right down to an individual kind of entity level is a substantial undertaking. So sectoral collaboration can help to ensure that this translation is done in a more consistent way and it's also a bit more efficient than having every entity go out there and do it separately and individually. So that means what we're trying to do is to help CREs to avoid that situation you can see on the left, and get them to a point of much more the coherence of the situation on the right, because we think that's going to encourage more consistent disclosures both within and across sectors. But that's not a mandatory part of the standard, but we think it's a really helpful way for entities to start to meet it. So we're working on our first piece of guidance on scenario analysis at the sectoral level at the moment, and that's going to be released in the coming months to help support further this consistency. And one of the key aspects of that is what you see on screen at the moment, which is a sort of scenario architecture, which is an illustration of that translation of high-level projections and pathways and scenarios for use in entity-level disclosure. And in order to develop scenarios which make sense of the work that's already been done globally to illustrate plausible physical and transitional change over the decades to come, entities are going to have to make some choices about how to navigate down that cone that you see in front of you. So they have to pick things like RCPs, SSPs, shared socioeconomic pathways, which energy scenarios they're going to use, which physical impact projections, whose physical impact projections are they going to use. which projections of international domestic carbon prices, energy and transport mix, land use patterns, and in order to assume, and when they're thinking through the implications of change in their strategic context, they'll need to have some clarity about what those assumptions are. And we think it's really important for primary users to be very clear about what those assumptions have been as well. And onto that next slide there, Jack. And this is sort of broadly speaking where we think things are at with the sectoral scenario analyses. So Marine have already been through one iteration, that was in 2020. General Insurance is well underway with their analysis as well, and making great progress. Tourism and banking, buildings and materials and energy seem to be the next cabs off the rank. And the other sectors there are still in the planning stages, with some encouraging developments sort of starting to come along with agriculture, health and life insurance. We've had some interesting chats, fund management as well. I think kick back to you, Jack, at this point.
Thanks, Steph. Yeah, that's a great run through. Conscious of the time, so yeah, we'll keep the pace up. So this slide is effectively a bit of a response. Some of the feedback we've heard, even since issuing the consultation document, is that some of it appears to be getting at quite detailed information and potentially into the space of disclosing confidential information. We'd encourage entities to have a look at what the TCFD said on this. So they have this slide here, and they have other information and guidance already around, a test and considerations to work through in terms of that boundary between information that does need to be disclosed in line with the standard and confidential information that can be held back. And so there's those two blue boxes there in particular, and we'd encourage entities, if there is particular concern around specific disclosures, is ideal for us in terms of getting information that we can use to feed into the development of the standard. But yeah, if you do have any particular concerns, or you think there's anything specific to your entity type, then we're very keen to hear from you around this. And the last sort of high level disclosure area for strategy, we've worked through ABC, and so this is D, which we've mentioned a few times already. So this is the methodologies and assumptions underlying both the climate related scenarios that have been used and the process that's been employed. And so this is what we've added as a high level D disclosure, but we also consider that it's consistent with, we've drawn this largely out of TCFD's guidance on scenario analysis. We also think this is where the Technical Readiness Working Group and some of the other global climate standard setters are looking to go as well, in terms of making sure there's some more transparency around what is being done on scenario analysis. And so the disclosures we're proposing in this area would be a brief description of each scenario's narrative, description of the various pathways that are included in each scenario, key assumptions, sources of data used, and then also the governance processes used to oversee and manage scenario analysis process, including the role of the board and management, because we think primary users want to know, has this been given to one person to sort out in the building, and then check that's sorted, or is the board actually engaging with these scenarios in a strategic setting to really think through what the rest of the strategy section is getting at around potential changes to the strategy that may be necessary. So we've got about 5 minutes left. I do have a couple of quick slides which are just trying to make sure that everyone's aware of what the TCFD said on portfolio alignment, maybe draw a little bit of a distinction between how we're seeing that versus scenario analysis as we're proposing it in the standard. So portfolio alignment is a tool, also called a metric, for forward-looking analysis as well, and that looks at the degree of alignment of a portfolio with a certain climate target. And so the TCFD's guidance, again, late last year, recommended that all financial institutions would start to disclose the extent of portfolio alignment. And so that sits up and under, in our view, an industry-specific metric. And so, as Judy will touch on in her metrics and targets sessions later, we're not proposing any industry-specific metrics must be used, but obviously if entities are doing portfolio alignment, we think that that's they'll likely want to disclose that in the metrics and targets section. But important to just draw this distinction between that type of work, which we would see as more normative on the right-hand side, working back from a particular desired end state, being that 1.5 degrees aligned future, and to think about the implications in a more of a backcasting type way, versus a more exploratory approach to scenarios where you're saying what are the range of plausible futures that we could face that goes out into that hothouse world, greater than 2 degrees world, and then the strategic conversations looking across multiple futures rather than only having regard for one. And as Ronan said, you know, Mercer has effectively been doing a combination, it sounds like, Ronan, in terms of you finding value in kind of multiple ways to look at these climate risks and opportunities. So we think it's important just to be aware of that difference. So 3 minutes to go, and
Thanks,
I will, yep, how are we going for questions, Amelia?
We've got loads of questions.
Have to answer quickly.
Yeah, I think we've got one really, we've got a couple of very similar questions, which are talking about the cross use of these scenarios developed at sector level. So, you know, for example, agriculture sector scenarios, we have interest of financial services, but then financial services are doing their own. And then fund managers especially, you know, will want to have visibility across all of these sectors because they are going to be a primary user of these different sectors reports. So just a bit of a question about how does an entity get involved in all these different sector level scenario constructions? How do they disclose what assumptions, etc., they're using, and how might that work? Do they need to have one particular view that they choose or not?
Okay, thanks, Amelia. Well, if you want to get in touch with us, please do, in terms of trying to stay across any movements on sector level scenarios. We're trying to keep our fingers on the pulse of as much as we can across the board. Obviously also encourage you to be talking to other people in your sector to try and make sure you're across anything that's maybe coming to light at the moment. With, you know, there's a good point about, for example, banking and agriculture. You know, how would those two pieces of work, if they were taking place around the same time, talk to each other? And we do think that very quickly then, for the banking sector, say, that ability to communicate effectively even with that other project on agriculture is an important consideration. So we've been encouraging the banks to be thinking about that. We've been encouraging the agriculture sector to think about it in the other way, you know, and to some degree, my view is that until you get yourself in a pretty solid position in this space to be able to influence someone else's piece of work, you need to be aware that other people are going to be doing scenario analysis that probably includes your sector, and that means they need to make assumptions and judgments about what climate risk and opportunities could do for you, and therefore if you don't like what they're doing and you think there needs to be improvements, you know, you've got to get yourself in a pretty decent position to be able to actually have influence in that space. So I think that the fact that many sectors are coming together to do this work is probably quite relevant to many.
And also just add to that, structurally, we're trying to impose a bit of rigor on that by having those architectures that are horizontally and vertically integratable so that they can actually speak to each other. So it's possible to say under one set of assumptions, this is what agriculture, marine, horticulture, insurance, banking are all disclosing, and that is coherent with your own disclosure if you use those same assumptions.
So we're out of time. Unfortunately, we've had so many questions. We've got lots of questions in the chat that we didn't get to. We will be collating them all, putting them on our website, answering questions. Please go have a look. Contact the team at climate@xrb.govt.nz if you have any specific questions you want to know an immediate answer to. And we're really, really keen to get your feedback in any way that makes sense to you. You do not have to provide a formal submission. You can just send an email to us with any comments that you may have. We're really keen to understand your views. So again, thank you very much. Thank you to Ronan for joining us. We really enjoyed your insights and experience. Thank you to Jack and Steph, and thank you to each one of you for all your questions and your attendance. Mā te wā.